We are at PDAC 2013, and I'm talking to Rick Rule of Sprott Global Resource Investments. Welcome to TNM TV, Rick.
Pleasure, Alicia.
Let's start off with gold. We've recently seen it pull back below 1,600. Where do you see it going from here?
You know, Alicia, well, let me answer the question directly by saying higher, but it could go lower first. Retrenchments are natural and healthy elements of bull markets. This is a natural and normal decline. I think it's the 8th in the gold bull market that began in the year 2000. In every prior retrenchment or retracement, there has been a recovery, and I would expect that to happen this time. It may not happen in a schedule that suits most people, but gold doesn't care what most people think.
And you're also not as big on gold as you are on platinum and palladium. Tell us a little bit about that.
That's a very good point. I, of course, think all the precious metals are going higher because they're denominated in U.S. dollars. And as you make more U.S. dollars, you certainly don't make them more precious by making them more plentiful. So I think that if you deteriorate or depreciate the denominator in the equation, that all the precious metals will do well. But I'm particularly attracted to platinum and palladium because the supply-demand scenario with regards to platinum and palladium is so compelling. With regards to the precious metals, one thing that you're talking about is you're talking about the sort of psychological value of a medium of exchange that's simultaneously a store of value. But with platinum and palladium, you're talking about something that gets used. It goes out a tailpipe, it goes up a smokestack, or it gets turned into jewelry. It has the most compelling supply-demand fundamentals in the bullion business. Yes, buy gold, yes, buy silver, but absolutely take a look at platinum and palladium.
Recently, we've heard about investors pulling out of gold and going into U.S. equities. Are you seeing that at Sprott? And if so, do you think it's going to be a sustained trend?
Sprott is a specialist manager. Eric Sprott, in a sense, is a thought leader in the precious metals business, and we're a resource house. Most of the investors that we have been with us for many years, some of them decades. We are not seeing the transition out of resources into general equities. I think generalist managers, people who manage across a broad spectrum, are in fact seeing exactly that. The momentum trade is certainly towards U.S. equities, and perversely in this era of low interest rates, still towards bonds. We don't see that in Sprott. The investors that we have in Sprott are by nature resource investors. They're attracted to Sprott because Eric is a thought leader in the bullion business, and they're attracted to us as a consequence of very, very, very long-term performance. So yes, the trend is happening. No, it's not happening particularly at Sprott.
The past 2 years have been challenging for miners and for on the exploration side. What has been your strategy during that time, and how successful has it been?
If you've been in the resource business as long as I have, what you learn is that you're either a contrarian or you're a victim. In very good markets, you have to have the intelligence to sell. In very bad markets, you have to have the courage to buy. We are becoming aggressive in this market. Other people's terror, of course, works to our advantage. We have experienced compression in Sprott in our publicly traded mutual funds because as the public gets scared, as the market gets lower, of course it costs us assets. Across Sprott, however, our bullion franchise has grown tremendously, our private equity business has grown tremendously, and in particular our lending business has grown tremendously as other equity sources have dried up. With regards to the market in general, or rather the resource equities market in general, you need to bear in mind two things. One, the industry's worst wounds were self-inflicted. The stocks haven't performed because the companies haven't performed. Look at last year as an example. Everybody talks about what a poor market it was for juniors, but people who made discoveries like Reservoir Minerals, 26 cents to $3.30. Gold Quest, 6 cents to $1.60. Africa Oil, 80 cents to $10. A market rewarded performance, and the industry didn't give it performance. The second thing to understand is that many natural resource investors don't understand very much about natural resource markets, and they tend to be extremely aggressive in periods like 2010 when the market is overpriced, and extremely negative in markets like this when the market is underpriced. With financial assets, people tend to shun goods on sale. They want stuff that's marked up. It's perverse.
How can investors that may be short on cash right now make the most of what you say are buying opportunities?
That's a spectacular question. People need to look at their whole portfolio and they need to forget what price they paid for a stock. I talk to investors and they'll say, you know, they'll pull up some name and I'll say, well, you should sell it. And the other investor says, I can't sell it. I paid $2.30 for it. It's selling for 20 cents. I can't sell it. If I do, I'll lose $2. I'll say, no, you've already lost $2. What matters is what you're going to do with the 20 cents. Go through your portfolio and benchmark it. Learn enough about the companies in your portfolio. Forget what price you paid for it. Think about what you're going to do with the money that's left. The way that you capitalize your portfolio is with the stocks that are already in your portfolio. And I guarantee everybody, myself included, has lower quality stocks in their portfolio that they should sell to upgrade the portfolio, irrespective of how much it hurts psychologically to admit defeat or admit the idiocy of the markets that we were all involved in 2010.
Juniors are very much unloved right now. The TSX Venture Exchange has declined by probably more than 50% over the last 2 years. What's your message to investors who have been scared out of the market?
Well, first of all, invest in yourself before you invest in the juniors. This is a stock picker's market. If you look at the whole junior market, it's valueless. All of the performance comes from the best 10% of the stocks in the sector. Develop the expertise to understand how to separate the wheat from the chaff. And then remember that a market that's 50% off has 50% less risk by definition. When things are cheaper, you've mitigated some of the risk simply by buying stuff that's on sale. The point is, however, don't buy the market. If your broker sells you the market, he or she will live up to their name. You'll get broker and broker and broker. You need to use the market as a facility to buy and sell promising information, or promising companies, not as a source of information. It's critical.
Even in good times, there's a perception that the markets are stacked against retail investors. Is it true? And if so, how can lay investors level the playing field?
The market is stacked in favor of intelligent retail investors. The intelligent retail investor is competing against a money manager whose orientation is in the very, very, very short term. The best arbitrage in junior mining is the difference between the short-term orientation and the long-term reality. You add value and exploration by answering unanswered questions. The wonderful stories in the Northern Miner concern how somebody answered an unanswered question. That's how you add value. And answering an unanswered question can take 12 months or 18 months. You, as an individual investor, can have a 12-month or a 24-month time frame if you discipline yourself. A money manager who has inflows and outflows cannot compete with you as an individual investor. The odds are stacked in favor of the intelligent individual and against the money manager that has inflows or outflows at the whim of the market.
Thanks so much, Rick.
Pleasure. Thank you.